Hello there, I'm Richie Owens, and I'm going to take you through this chapter 4 of the Foundations of Risk topic on credit risk transfer mechanisms. Now, before we get into the LOs that we're going to look at, the learning outcomes, let's just focus on this word foundations. We're still in the foundations topic, so we're not going to get into the nitty-gritty here. It's going to be fairly light touch. Focus on what are these instruments that we're looking at? What are these mechanisms? How do they work? Advantages, disadvantages, that kind of thing. The detail on all of the contracts, how they're set up, the issues, you'll have to wait till later in the curriculum and even into part 2. That said, what are we going to look at? Well, 4 learning outcomes we'll focus on here. First of all, we'll go through the traditional methods of managing credit risk. How did it used to happen before the world of credit derivatives? Then we'll look at the types of credit derivatives that are traded at the moment. That's a big one. If you look at the FRM text, that LO is clearly there. The learning outcome is there, but there's not much detail in GARP's own text. So we're going to look at a few instruments, but as I say, we're not going to get into a lot of the crunching detail. Then we'll have a look at the securitization process. And once we've wrapped all that up, we'll take a look at the role credit derivatives played in the 2007 and 8 global financial crisis. So, without further ado, let's have at it. Traditional methods, first of all, pre the world of credit derivatives. What do we have? Well, there were lots of methods, and we're going to just do a callback here to an earlier chapter on how firms manage risk. And just think about the 4 methods: avoid, transfer, mitigate, and retain. A lot of the traditional methods of managing credit risk involve mitigating it. So think of a bank taking on a portfolio of loans and trying to put in place some preventative detective controls to mitigate the risk. First up, accounting for counterparty risk. Here, parties agree exposures can be netted. So if I owe you 3 million, you owe me 2 million, let's say, we net that off so there's only $1 million outstanding. The benefit, well, if this netting were not done and one of the counterparties goes bankrupt, the obligation from one party is eliminated whilst the other is still liable. So let's say the 2 million disappeared, worst case scenario, we have a $3 million liability. After netting, it's only $1 million. Margining or mark-to-market pricing goes a step further. It's counterparty risk accounting with regular revaluation of positions. Benefit of that, it minimizes net exposure. Best example, think exchange-traded derivatives. So a futures exchange, at the end of every day's trading, futures exchange marks your position to market. Any gains get put into your margin account, any losses taken out. And if your margin account is low enough, there'll be a margin call. So you're resetting your position to 0, so there's nothing outstanding before you go to the next day. Again, mitigating the credit risk outstanding. Option to terminate. At the initiation of the agreement, both parties agree when the position must be unwound. So could be change in balance sheet, income statements, other defaults, downgrades, anything like that. If it's a put option, then the lender has the power to force the unwinding. And probably the easiest to remember, collateral. Minimize credit risk by requiring collateral to be posted. Doesn't eliminate risk because the collateral itself still has risk. Its value might still change. So they're all your methods of mitigating. Back to our classic ways of dealing with risk, you can also transfer. And again, prior to the advent of credit derivatives, there were some methods you could use to transfer credit risk. First of all, syndication. Your original bank loan originator here is arranging to distribute part of the loan transaction to other banks. By unloading the loan, you are also distributing the associated credit risk. Don't have to get rid of all of it, might keep a percentage of the loan. We're saying here, for example, 20%. But the rest of it has been moved on. 2 types of syndicated loans to be aware of: firm commitment and best efforts. In a firm commitment, the bank is guaranteeing that they'll be able to distribute the loan and get the funds. If they can't, they'll have to take it on themselves. It'll stay on its own books. Worst case scenario, nobody is interested. They have to take the entire loan on. Best efforts, they promise they'll try to find other investors. If they can't, then there's no guarantee that that money will be raised. Very similar to those terms in the equity markets. Another method of transfer, secondary market loans. So a loan is made and then sold on afterwards. So whoever made the loan can choose to sell it on and hence distribute the risk. Assets and hence credit risk can also be transferred in the event that something happens to the loan. So some sort of adverse event, a ratings downgrade, something like that, might trigger the transfer of the loan. And insurance. Insurance purchased from an